The last video covered when a state can tax a business. Now we need to work forward from that point on how a state will determine taxable income to ultimately get to rate times base, which is state tax liability. This is another video where you may want to get your calculator handy because we're going to work through a bunch of examples. This is VideoT13B on state apportionment. Let's start with one of my favorite imaginary businesses, Colbert Nation Inc. I'm not exactly sure what Colbert Nation does, so use your imagination. Like so many other mid or large-sized businesses in the U.S., Colbert is incorporated in Delaware, but is actually based elsewhere, and in this case, it's Hollywood, California. But Colbert also has offices in New York and Chicago. It has customers in a wide variety of states, and frankly, its customer base can change from year to year. Its employees serve local clients, that is, clients in states in and adjacent to their home office, but they also travel to other client locations and offices. Basically, Colbert is all over the map. So Colbert keeps one set of books and reports taxable income calculated under federal tax law of $500,000. We already know that Colbert is in a number of states. So, how are they supposed to determine what state gets to tax the $500,000? Let's consider a couple of possibilities. Each state could tax the full $500,000. If Colbert happened to be in all 50 states and the District of Columbia, and if we assume all states have a tax, which we know they don't, but that each state has a modest 5% tax rate, then that $500,000 would be subject to a collective tax rate of 50 states times 5%, or 250%, which would mean that making money is actually a losing money proposition. That won't work. Okay, so what if we use a uniform distribution, where you take the $500,000 and just divide it by the number of states that have nexus? This would avoid the double, triple, or greater taxation of the $500,000, but how would the individual states feel? If Colbert has 30 clients in New York and 1 in Rhode Island, and the revenue generated from these is consistent with the number of clients, does Rhode Island deserve as much of the income as New York? I doubt New York would think so. Let's pause on this topic for a moment because we're going to come back to it. But it seems like finding a way to measure the economic activity that a business has in a state is one way of dividing the income and attempting to give each state its fair share. But even before we get to the distribution of income across states, consider this. Our starting point was federal taxable income. Do you think that all states simply adopt the calculation of taxable income consistent with the U.S. government? I will answer that for you. No. Something as simple as depreciation can differ widely. Remember Section 179 and bonus depreciation? States may adopt those provisions, or maybe not. So step one is to recalculate total income, that $500,000, except use state tax laws instead of federal tax laws. Each state can be different. So the differences between federal and state taxable income can vary. Here's a list of common adjustments. So we call that new state law-based taxable income amount the state tax base. But the state tax base, which there could be potentially a different base for every state, still doesn't represent the amount a particular state can tax, because it is still the nationwide income of the business. But at least now we're ready to divvy it up. Most states use two systems to divvy up the state tax base, and these are not separate and distinct systems, but rather complements of each other: allocation and apportionment. Allocation is the identification of a specific type of income, and then the attaching of that income to a specific state based on some fairly intuitive choices. Allocation is used for non-business income, such as interest, dividends, rents, and royalties. For example, if a taxpayer has rental income, it would make sense to source that rental income to the state in which the property being rented is located. The rules can differ from state to state, but generally follow these guidelines. Interest, dividends, gains, and losses, these are all allocated to the state of commercial domicile. Now, commercial domicile is the location in which the business is headquartered and not necessarily where it is incorporated. To put this into a California context, California generally follows these rules with the added twist of when the income just happens to be allocated to a state without an income tax, California reaches out and grabs it as if you are domiciled in California. So, quick side note. If the business happens to be a rental business, then obviously rental income is business income, and only non-business income is generally subject to allocation. Which leads us to do with what do we do with business income? Well, a system known as apportionment is used for business income. And it should come as no surprise, because you're getting used to this, that each state defines apportionment differently. But now is when we get to reach back and revert to our original discussion on how are we going to split up Colbert Nation's $500,000. Because there's a sense that economic activity makes a useful driver for apportioning income, the original and most widely used method by states was known as the three-factor apportionment formula. And that considered the level of property, payroll, and sales in a state. Each state's share would be determined by taking the in-state amount and dividing that by the total amount for each of those. For policy reasons, we're going to see shortly that there's been a shift away from three factors towards a more heavily weighted sales factor, or even only a sales factor. So in each state, the amount of in-state property, in-state payroll, and in-state sales are divided by the total amount of each. These three fractions are then summed and divided by 3. I think the only way to understand this is to prepare an example. Let's look at MIC Inc. So we have their payroll, property, and sales data. We can use this data to compute the apportionment percentage for New York. We'll assume New York uses a three-factor equal-weighted formula. If you're adventurous, get your calculators out, stop now, and work on it. Otherwise, we're going to work on it together. Okay, for the adventurous type, let's start with the sales factor. So New York's share of sales was $300,000, divided by total sales of $750,000, for a sales factor of 0.4. The New York payroll is $400,000, divided by the total payroll of $550,000, or 0.727. And the property factor is New York's $100,000 divided by the total of $180,000, or 0.555. Then take all three factors, add them up, divide by 3 to get the equal weighted average apportionment factor of 0.5607. Multiply that by the $100,000 of state apportionable income, and New York gets $56,070. So did you notice that New York had a large share of both the property and the payroll? This would imply that MIC has a fairly large economic presence in New York. Well, the politicians in New York like MIC, especially all the jobs MIC has to offer. And so to favor businesses like MIC with a substantial in-state presence, The New York legislature decides to double weight sales. Let's see how that affects the outcome. So the factors are going to be calculated in the exact same way, except now the sales factor is multiplied by 2. And therefore the final apportionment factor needs to be divided by 4. The final apportionment factor is now 0.521, and thus MIC has 52,100 of New York income. This compares to the 56,000 using the 3-factor formula. So you can see that double weighting the sales factor favors businesses with a large in-state presence. This has been taken literally to the nth degree, with certain states who have gone to completely a single sales factor apportionment formula. If MIC had applied a single sales factor, New York income for MIC would have been only 40,000. So you can see that sourcing income to different states with different tax rates is precisely what the jurisdictional planning variable entails. However, I think it's important to note that taxes are not the tail that wags the dog. In fact, a recent survey shows that corporate tax rate is ranked well below a number of other factors, such as labor skills, transportation, and labor costs. So, I think our takeaway needs to be that tax is only one factor to consider, and may not even be the most important one. The only thing that should follow as takeaway is a finish. And here we are at the end of video T13B on apportionment. We're going to examine international issues next. Thanks for watching.